Energy Media readers, if you are situated in Alberta, you've heard a lot about what's going on with the oil sands thanks to the oil price war and the pandemic. And one of the things we're going to talk about today is capital expenditures by the oil sands, which have basically fallen off a cliff in 2020 after a promising start. To talk to me today is Kevin Birn, who's the manager of Oil Sands Dialogue for IHS MarkIt. So welcome to the interview, Kevin.
Hi, Markham.
Now, look, over the years, you and I have had many, many discussions about how the oil sands uses capital, why it used a lot more during its expansion phase, and why it uses a lot less during the sustaining capital, operations. But boy, this is the blog post that you put up a day or so ago is a big drop off even by the standards that we talked about. So maybe give us an overview of the blog post, please.
Sure. Yeah, we released kind of a highlight of looking at the impacts in the Western Canadian Sedimentary Basin of the low price and basically the demand shock rolling through because of the COVID-19 impacts. And inside the blog post, we talked about the fact that we see about a $6 billion cut in upstream capital, well, I shouldn't say upstream, capital spending in oil and gas sector as a whole so far. That includes the oil sands, conventional, unconventional, midstreams, and NGLs as well. We talked about our drilling expectations for the year, how our outlook has been cut by a third. We only have we were already at low levels, but we have about 3,500 wells left in our outlook, with even, if you consider a good chunk of those were already drilled in the first quarter as well. So it's pretty bearish looking. And then we also talked about and compared the upstream capital spend on new projects in the oil sands over time. We've been tracking those for a long time, and then we now see it at a 15-year low.
Yeah, I noticed that. I mean, the chart that you have is quite startling. It shows that this year's capital expenditures are equal to those of, what, 2004?
3 or 4. It involves, it's real dollars, and there's exchange rates in there because we're converting it. So, depending how you work it out, it's 2003, 2004.
Now, to sum up a bit of the conversation we've had in the past, the oil sands is different than conventional oil because it spends a tremendous amount of capital at the beginning of a project to build plant and infrastructure and all of that. And so we see a big spike in capital expenditures in 2014. I think it was $63, $65 billion. Now we were down to like $9 or $10 billion of sustaining capital, basically, to keep that plant running, because it's more like a manufacturing plant than it is a traditional oil field. And where are we at now in terms of amounts?
In terms of upstream capital spend, we have it sitting around about $5 to $6 billion this year. That doesn't include necessarily the sustaining capital and the operating costs inside that. That would be new capital investments. We do see that, basically in a low price environment, the companies have the ability to kind of ratchet back. And so the oil sands, like any upstream producer, I should say, the first thing you do is you cut your cash expenditures. So anything that's discretionary, any planned investments, so any projects, you defer them. You're just not spending the money. It's like you and I, if we get a shock in our revenue stream, we're just not going out for dinner anymore. So it's the same sort of initial impact. The secondary impact is they start cutting into meat. That's laying people off, that sort of thing. In the oil sands, they can also forego their sustaining capital. So while the oil sands are large manufacturing kind of, I call them utility oil. If you put the money in, you can maintain them. And so one of the things they can pull back on is sustaining capital. And that kind of, best way to think about it is that goes to, in the thermal side, that would go to be drilling out replacement wells. So every, I'm going to overly simplify, every 10 years, you're going to have to replace some of the well pads you had and to keep that production flat. Well, in the short term, you can pull back on that capital. And you may not see a material impact on your output because you kind of have a lead time into that.
Now, one of the conversations that you and I have had since 2014 is about how the oil sands companies have been able to drive down their operating costs. And they're actually been very successful at that. Where are they at now? And what kind of an oil price do they need to break even, maybe even make a little money?
So basically, if you just look at pure operating costs, since 2014, we've tracked about a 40% reduction. And some producers knocked 50% out. So you can think about your expenditures at home getting cut in 50%. That's a significant reduction. But to look at where they're at, you really need to include other costs. And we consider it a cash cost to look at. So if you're producing bitumen, you need to acquire condensate, you need to ship it to market. You also have to think about quality differentials if you want to compare costs. So we tend to do that against WTI. We put most of the producers, most of the operations out there, they're actually all very highly correlated. There are outliers, but they're mostly correlated around the same sort of numbers. We have most of them around on a cash cost basis, so greater than operating cost market, somewhere between low 20s to mid 20s dollars a barrel WTI basis right now. I think it's important for listeners here to understand is those costs do move around. There's good chunks of those that are market based. So in a low price environment, those cost structures do fall. Things like diluent cost that you pay the prevailing price, like it's just going to track oil, it goes down. Natural gas, well, that's actually going up a little bit right now. And the exchange rate, they pay a number of their costs in Canadian dollars and they sell their oil in US dollars. And so there is some give in low price environments that brings down that cash cost break even. But I think, at the prices we're seeing in Western Canada, it's still safe to say that they're all in the red.
What role does the fact that some of these producers like Suncor, Husky, Imperial are integrated, that is, they own their own refineries and upgraders, some of them in the United States, does that provide them with an extra level of cushion in a low price environment?
In terms of the economics, it can, but I think the real in this, back up, the degree of the demand shock that we expect to see over 16 million barrel decline in demand this quarter. That implies a surplus build the likes of which the world has not seen. It will means every producer is going to search for every bathtub, ditch, and tank in sight to be able to place that crude somewhere, because the refiners are going to cut their production or cut their runs, and so the demand for crude is going to fall. What an integrated facility can offer these guys is a home for their barrels. Now, even the refiners are going to have to cut. We're seeing impacts on jet demand, gasoline demand, even diesel. Diesel's more insulated, but we're seeing impacts across the board. So integration can provide you additional places to basically land your barrels and more options to store, because you can store as crude and you can store as refined product too. So that may be a huge advantage for them because they can flow their barrels through those refineries. And if they're, competitive refineries, they may be able to continue to produce through that. As ultimately what's really going to matter in this environment where you're going to have a rush for storage is optionality. Optionality to get to key markets, move around refineries that cut runs, and get to new storage opportunities, or land your barrels in refineries that are going to continue to operate.
And so what about the companies themselves? They had a pretty good year in 2019. In a previous interview, you had said that they've got some cash in the bank, they've got their balance sheets repaired, they have access to capital. We saw this week Suncor announced that it had taken on some new, had sold some bonds and had arranged some $2.5 billion of new credit, that sort of thing. Are they reasonably well situated to survive even a demand shock like this?
I'll go back to 2014 and give you a bit of a comparison now. Like 2014 was a rolling collapse, and the nadir was in 2016, so it took a little longer. But in 2014, we went into that collapse. These companies had many projects under development, so they had large capital expenditures. And if you look at that capital chart we shared in the blog, you can see that they continue to expend money. And so even though the prices were in a place where they weren't making really any positive cash flow, especially in 2016, they continue to spend money. And if you look at their actual cash flow returns in those periods, they weren't really making a heck of a lot of money. And if you look at where we're going into this one in 2019, yeah, they did have a pretty good year. I think the average free cash flow is something like $4 billion for the 4 or 5 major oil sands companies, which is quite significant. They all had dividends going on. None of them have really any projects in their development. There's some smaller things here and there. There was some projects likely to come back into the fold that have been deferred. So they don't have the same burden of expenditures on the books that they're going to continue to put cash into through this period. They went into it with fairly strong balance sheets and even some money in the bank. So financially positioned, they're going into this much stronger than the last collapse we saw. Or we did see one in late 18, but I'll skip over that. But this one is going to probably be deeper. We've already seen lower prices, and it's probably going to be, in terms of low price environment, probably more protracted and we'll come out of it, but it may take a long time to come back up in prices because of the inventory overhang we'll see. So yeah, they're in a better position, but Markham, the bottom line for these companies, the big ones, is they're generally integrated, which does provide them more optionality. They're bigger fiscal balance sheets, so they have more assets there, so they have more to leverage, and they can access to capital more readily because they are bigger and seen as lower risk compared to smaller peers. So I think those are the key differentiators, but distinctively different entrance into this price collapse than 2014.
Final question, Kevin. I'm always telling my readers, and maybe hopefully correctly, that the heavy oil market is, when we're talking about oil in Alberta, we're mostly talking about heavy oil. It's not the light sweet crude. And how will the heavy market, the 10.5 million barrel a day heavy market, respond to prices compared to the rest of the market?
Prices are demand. I guess I'm just looking for clarification, Markham.
Yeah, I guess the question is: Are we going to see the heavy producers and the market, the demand for heavy, collapse in the same way that the light markets are going to collapse?
I don't have a slate analysis of where the refineries are going to go to really provide you any kind of real solid guidance there. But I would say we would expect refinery run cuts kind of across the slate. Now, the degree to which the advantage of a heavy and even a medium barrel over a light barrel, the key distinguishing feature is how much of these heavier, longer molecules are in there. The heavier and longer molecules are often better for distillate diesel, or generate a greater yield of diesel, which is weakening in this market, but not to the degree that gasoline is. So barrels of oil with more naphtha, lighter, ultralights, will probably face more potential pressure from refineries. That being said, I think the key challenge here isn't necessarily refineries, differentiating refinery crude quality in Western Canada. It's again that optionality to be able to store and access refineries in other regions. We're already seeing what we think is significant cuts coming off from Western Canada, which will reduce potentially the need to seek those inventories. But the challenge for Western Canada has been access to market. Now, we do see some slack in pipelines, so it's not a physical pipeline issue now as production comes off, but physically getting it to these inventory centers, because Western Canadian inventories are already at high levels. So that's not going to provide much of many days of cushion as they build inventories in Western Canada. So they need to get to other markets to store. But even then, we're not convinced that's going to be enough. And we do think production will have to continue to come off over the weeks ahead.
Kevin, thank you very much for this, and we'll be checking in with you regularly as this the downturn in the oil industry plays itself out, and hopefully we'll have a resolution fairly soon.
Thank you, Markham.